Welcome friends, welcome to Bankers Plus Academy video. In this video, we are going to discuss trade credit and the latest guidelines. You might be remembering that in 2018 March, RBI had discontinued the practice of issuance of LoUs and LoCs by banks. LoUs and LoCs mean letters of undertaking and letters of comfort. These were issued by banks for the purpose of trade credit. This happened after the rupees 13,000 crore fraud committed by Nirav Modi and his associates in Punjab National Bank came to light. After that, in March 2019, RBI has issued revised guidelines on revised trade credit framework. In this video, we will see the features of the revamped trade credit framework. To begin with, let us first see what is meant by trade credit. Trade credit is a short-term credit raised by the eligible borrower from recognized lenders for import of permitted capital or non-capital goods under the foreign trade policy of the Government of India and for maturity as prescribed in the trade credit framework. This means that trade credit is a short-term credit and it can be availed by eligible borrowers from recognized lenders. And also the purpose of availing trade credit should be for financing imports. And the maturity period of the loan will be as prescribed in the trade credit framework of RBI. In short, trade credit is a loan availed by the Indian importer for payment of his import bill. The trade credit or the loan is availed from banks situated outside India. Now, depending upon the source of finance, trade credit is classified into two. One is buyer's credit and the other is supplier's credit. Buyer's credit refers to the loans for payment of imports into India arranged by or arranged on behalf of the importer through an overseas bank or financial institution. Whereas supplier's credit refers to the credit provided by the supplier, that is the supplier of the goods. So the supplier of the goods himself is providing credit to the import in the supplier's credit. Who are the eligible borrowers? Persons resident in India acting as an importer is the eligible borrower for trade credit. So this loan can be availed for import of capital or non-capital goods. In short, the eligible borrower is an importer in India who is importing capital or non-capital goods. Trade credit can be raised either under the automatic route or under the approval route. Under the approval route, the prospective borrower or the importer is required to send their request to the RBI through their AD bank for examination and approval. Whereas in the case of automatic route, the request for buyer's credit or the request for trade credit can be approved by the AD bank itself. Oil or gas refining and marketing, and for airline and shipping companies, the maximum permitted amount that can be availed as trade credit is $150 million or its equivalent. So that is for oil and gas refining and marketing companies or airline and shipping companies. For all others, the maximum trade credit that can be availed is $50 million or equivalent. So $50 million is the maximum amount that can be availed for all other purposes under trade credits. And who are the recognized lenders? For buyer's credit, the recognized lender is the supplier of goods located outside India. That means the exporter or the overseas exporter who is exporting the goods to the importer in India is extending the credit. He is the recognized lender. For buyer's credit, banks located outside India, including overseas branches or subsidiaries of Indian banks. This means that Indian importers are permitted to avail trade credit from foreign banks located outside India and also from foreign branches of Indian banks. For example, trade credit can be availed from banks like HSBC Hong Kong or Citibank Singapore, and also from banks like SBI Hong Kong or Indian Bank Singapore, who are Indian branches of foreign branches of Indian banks. And buyer's credit can also be availed from financial institutions located outside India, foreign equity holders situated outside India, and also banks and financial institutions in international financial centers located in India. So they are the recognized lenders for trade credit. Then what's the currency of the trade credit? Trade credit can be availed in any freely convertible foreign currency or in Indian rupees. That means trade credit, buyer's credit or supplier's credit can be availed both in foreign currency or in Indian rupees. But foreign branches or subsidiaries of Indian banks can extend only foreign currency loans. Okay. So foreign banks and subsidiaries of Indian banks are not permitted to extend trade credit in Indian rupees. Now, trade credit maximum tenor, or the tenor or period of trade credit it is usually reckoned or calculated from the date of shipment, and the tenor for import of capital goods is 3 years. That is 3 years from date of shipment. That is for capital goods. For non-capital goods, the maximum permitted period or tenor is 1 year or operating cycle, whichever is less. Okay. So for import of capital goods, the maximum period permitted is 3 years, and for non-capital goods, it is 1 year or operating cycle, whichever is less. But for shipyards and shipbuilders, the maximum permitted period is 3 years. Now let's see the pricing. What is the all-in cost ceiling for trade credit? If the trade credit is availed in foreign currency, the maximum rate permitted is benchmark rate plus 250 basis points spread per annum. Benchmark rate here refers to 6 months LIBOR, that is London Interbank Offered Rate or rate of different currencies, or any other 6-month interbank interest rate applicable to the currency of borrowings. Once again, the benchmark refers to the 6 months LIBOR rate of different currencies or any other 6-month interbank interest rate applicable to the currency of the borrowing. And whenever trade credit is availed in INR, Indian rupees, the rate will be the G-Sec yield for corresponding maturity plus 250 basis points per annum. Okay, and this all-in cost ceiling includes rate of interest, other fees, expenses, charges, guarantee fee whether paid in foreign currency or INR, but it will not include commitment fees and withholding tax, which is payable in INR. Now the security for trade credit. Earlier, letters of undertaking and letters of comfort issued by the importer's bank used to be the security against which trade credit was granted. Now RBI has prohibited issuance of such LoUs and LoCs, but RBI has permitted the banks to issue guarantees on behalf of the importer in favor of the overseas lender for raising buyer's credit. Based on the guarantee issued by the importer's bank, the overseas bank, which is the financing bank, credits the amount to the nostro account of the importer's bank, and which will be used for payment of the import bill. So the issuance of these guarantees is subject to certain conditions. Which are the conditions? The conditions are that the guarantee amount shall not exceed the amount of trade credit, and also the period of such guarantee cannot be beyond the maximum period for trade credit. These are the latest RBI guidelines for trade credit for imports into India. If you found this video useful, please like and share, and also subscribe to our channel, Bankers Plus Academy. Thank you.